The investing world is getting more and more passive. By 2026 to 2027, exchange-traded funds will overtake active managed mutual funds in managing assets. This is a non-reversible trend. Warren Buffett always recommends the non-professional investors to invest in a well-diversified low-cost index fund, but with the exception to hold your investments over a 30-year period. Following the trend and Buffett's recommendation, you will achieve in maximum average returns. But investors who want to exceed average returns have to find better alternatives with different investment rules and mindsets. You have to break typical taught finance rules to find outstanding investment opportunities. In today's show, we are talking to Sean Emory, the founder and chief investment officer of Avory Company, an independent investment advisor with 350 million USD under management. Sean and his team invest in just a handful of companies with long-term sustainable growth opportunities. We will ask him about the advantages of being a professional stock picker in contrast to a passive diversified ETF investor. Sean tells us why he believes a concentrated stock portfolio can outpace average market returns in the long run. So stay tuned and have fun. Welcome to our channel. Today we have Sean Emory, the founder and chief investment officer of Avory Company, an independent investment advisor with 300 million USD under management. Sean and his team are value investors at their core, in search of quality companies led by talented individuals that offer long-term sustainable growth opportunities. They manage a concentrated portfolio with 7 up to 25 companies with a private equity mindset. They have developed a unique investment research process to find structural or transformational growth stories. Besides buying and selling a company, they use tactical option plays for entry, exit, or lowering the base strategies. In today's show, we are pleased to ask Sean 5 questions on how to develop and manage successful a concentrated stock portfolio in a more and more passive investing world. Sean, thank you for having you on our show.
Alex, appreciate it. Longtime colleague on different outlets like Twitter and things like that. So I appreciate the invite and happy to be here.
Yeah, thank you. Just as with a warm-up question, what is your personal background on investing and how did you become the founder and CIO of Avory Company? Who is Avory?
Yeah. Pretty good questions. I mean, Avory is nothing, right? It's not even really a word. It has some initial foundings of things like independent and wise ruler. If you look up, try to look up some meanings, it has a pretty unique look and feel to it. So just like we're pretty careful in our investments, we're pretty diligent and thoughtful of how we created the term Avory. Obviously, there's some words there that are tied to my last name and Emory, and essentially the formation of Avory was pronounced by that and my other founder. Now, as it relates to how we built the firm, I think what we wanted to do was build an investment firm focused on our key kind of research mission, which is discovering value in a world of innovative growth. And my initial foundings or the way I was brought up was really around analytics and data. And I've always had a natural kind of respect for taking data, factual evidence, and putting that into some form of investment per se. I've spoken plenty of times around my initial kind of 13-year-old self playing fantasy baseball, and essentially baseball is a highly data-driven sport, right? It's all about stats. And using that stats to potentially find kind of a feather or a gem out there in the world of baseball and essentially buying low and selling high. That was the fantasy baseball world. And that translates particularly well into the investment landscape, obviously, as I grew up and went to Stetson University, where I was part of the investment group there. And I was able to then take some of that knowledge from the institution, where we were running a high conviction equity portfolio of around 10 securities, and taking that into several phases of my work journey before starting Avory, as an independent, fully data driven, focused on discovering value in a world of innovative growth. On one side, it's about structural growth stories. On the other side, it's around transition stories, staying disciplined in our valuation approach, and essentially putting that in a high conviction equity portfolio. That's kind of the bread and butter. That's how we were formed. And we have a rich set of investors that believe in our process over the long term. And kind of that's how we were built.
So investing is part of your DNA.
Yep. Data analytics, and it translates well to investing. And that's always been my journey.
So let's come to our first question, Sean. In a comprehensive JP Morgan study on the broad Russell 3000 index, which represents more than 98% of the investable US equity market, they worked out that 60 to 70% of stocks in most sectors generated lifetime excess returns less than the average return of the underlying index. Moreover, more than 50% of all stocks show negative absolute returns since their inception. In the essence, JP Morgan recommends to diversify a stock portfolio to protect your investments. At Avory, you are managing, in contrast, a concentrated portfolio. What is your take on diversification, and why do you bet only on a handful of companies?
Yeah, so I think there's definitely good stats, and I think the stats that I think are mentioned in JP Morgan's data, I think play right actually into our wheelhouse. So at the core of a concentrated portfolio for us is really about knowing what you own and why. And this is especially true during moments like March of 2020, at the heart of COVID, really trying to determine what the health of each company in an index and its 3,000 constituents is roughly impossible. Trying to diagnose your 10 to 20 companies quickly was, I believe, advantageous to us. In addition, it's really around not only protecting yourself during those moments, but then finding opportunities, which is on the back end of it. And really searching through the rubble is also advantageous, as we don't necessarily need to make a sector call, an index bet. We could look at companies such as Paycom or Intuit at that moment in time, which were true investments we made, that were structural winners. And at that moment, we're trading at valuations that were attractive when you started to look out years. Now, obviously, the world quickly evolved, and those turned out to be fruitful. But at the same time, I believe that again, when you step back and you think about why you're concentrated, it's not only about finding those opportunities at like the index level, but it's also protecting yourself and knowing what you own and why. Now, lastly, I think what we're really trying to do is find that once in a lifetime investment, and that will compound for us for years and decades. Now, when you work the math from that study, I think what they mentioned in that study was roughly like 60% to 70% of the Russell 3000 underperforms, which the flip side of that is 40 to 30% roughly outperform. So you take those numbers, it's roughly 900 companies to 1,200 companies that are roughly doing outperforming these indices, right? So I think that's a large set of companies. When you take a portfolio of 10 to 20, we really only have to select 1% of those to be long-term winners in that case. So again, taking the data, taking how it's out there, I think another way to think about it is, where's the weakness coming from? Is it the microcap sections of the Russell 3000? Is it the highly levered plays, which we don't really play in? So I think as you dissect the data, I would hypothesize that the data starts to turn a little bit as you start to remove some of the areas that are possibly a little bit more speculative in nature and not necessarily something that we are part of. Lastly, on the study, they highlight that I think 7% of the data set are extreme winners. And this equates again to 210 companies, where we are only looking for a handful, maybe 1, 2, 3 throughout our lifetime, that would eventually be that game-changing kind of Apple and Netflix and some of these others of our time. We have found companies like Square fairly early, Omnicell, Wix pretty early, Chipotle on its turnaround. So our returns tend to align with that kind of a big winner mentality in a sense, and finding that one or two gems over several years. So we think, again, laying that foundation, understanding where some of the best investors have come from, Warren Buffett, Soros, Druckenmiller. We believe that several long-term winners is kind of the key to our strategy, and having that conviction, but also understanding what we own and why is pretty important to our overall theme and messaging.
And the formula was on diversification equals 1 divided by confidence. So,
right, exactly.
You have to understand what you are buying, and otherwise you have to diversify. Yeah?
Exactly. I think you nailed it on the head with the formula. It's that comfort in knowing what you own and why. I think that ultimately is just rather important as you go through, like when the world is fairly normal, and that's not that easy to say, because generally speaking, there's always time periods where every so often, right, there's rising rates or this or that. It's really those crunch time moments where there's mass fear in the markets. And in some cases, you're feeling that here in the last kind of week. However, again, I do believe that knowing what you own and why allows us to, again, quickly assess where the risks are for us, but also understand where the opportunities are within our large swath of companies we're tracking. So
in a concentrated portfolio, you have to live with, I guess, a higher volatility. If you invest in a new position, the stock does not automatically rise normally. Falling prices after entering a new position causes for many investors headaches and stressful, expensive actions. A typical investment cycle starts with a so-called J-curve. Can you explain us what that means, and how do you deal with this in particular in the communication with your investors?
So the J curve, obviously, there's different forms of it, but I know what you're kind of referring to in terms of in the public equity side. It's really it's I think 2021 has been a pretty good example for us. We've added several names this year. The timing has been mixed. Generally, to get access to a long-term structural winner, in our view, we would consider some form of margin of safety. The story cannot be perfect kind of at that time of the investment. Now, what that means is we're going from kind of this one extreme to another extreme in terms of sentiment. So what we're trying to do, obviously, is be kind of on the right side of that pendulum, and knowing that we're not going to be perfect. So take like Fiverr or Zillow, for example, here. We just started these positions rather recently and believe in the long-term kind of nature of these assets. Zillow is one of the more prolific internet assets in the world with scale and reach like very few have. Real estate, we know, is going digital. Even when you look at the digital world, people are buying and selling real estate, and can Zillow be the ultimate metaverse company? And I kind of say that tongue in cheek, but the story was perfect a year ago, only to be met with kind of the fear that we're talking about of rising rates, the closing of offers. And now you have a core business trading near 16 times kind of cash flow with structural tailwinds behind it. And so we bought higher, obviously, but we've been buying down. And as this dislocation continues, again, we start to lower that cost basis over time. And that's ultimately what happens. Again, is we won't be perfect on the entry ever. In some cases we will, in some cases we won't. We've had plenty of moments where we've timed that perfect bottom. But again, it's mixed, and we're not necessarily trying to time the bottom. We're just simply trying to find a story where we have this margin of safety. I think, again, the irony here is that so that's kind of always been the nature of our investments. If you look at some of our best investments, right, you take Capri, and we've been talking about Capri, you and I, for several years now. Look, it was down 30-40% for us before we obviously continued to buy lower and lower, and eventually it was many multiples from our cost basis. Chipotle was the same thing. We were down 30-40% before we made many multiples on that transition story after they hired Brian Niccol. And then Wix was down 50% in 45 days. I'll never forget it, before a strong secular winner that took place. So the last 6 months have been pretty volatile. Underneath the index, we're seeing some of those ourselves in our portfolio. look, we don't own it, but look at PayPal. It's making 1-year lows, Disney, Square, Zoom, Roku. The list is just large and growing. And these are levels that we haven't seen since the heart of pandemic. So again, it's the nature of the beast in terms of high conviction and also investing in the markets in general. But again, it goes back to probably our last question that you asked, which is really know what you own and why. And that's really what gets you through these times. And then finding those structural winners as there's dislocation, I think, is our core advantage.
Do you have sometimes issues with your clients because of this high volatility sometimes?
From time to time, there's obviously questions around anything. And that's obviously something that is part of what we do. And I think what we do a good job at is communicating the rationale of being in an investment. So we share all of our research from kind of literally the start to the finish in terms of why we're looking at it, where the idea originally came from, and ultimately where we think this thing is going. And we do a good job at communicating as we progress through the story, right? So our quarterly takeaways that we send out to investors, obviously our quarterly reports that we talk about kind of each investment. We regularly communicate with our investors at the kind of pattern that they want to communicate with us. And again, we're highly transparent in terms of why we own things and or what we own and why we own it. So again, taking that internal kind of strategy and procedure of us knowing why we own things and why we own things and why, or what we own and why, and then translating that to our investor base, I think is utmost important with a strategy like this, but just a strategy in general. I do question why that's not more the norm in most of the strategies that are out there in terms of communicating each investment and all the details around it.
Yeah, communication is core. And the good thing is it's not only for your clients, you are also open to the public. And for our audience, everyone can follow you on Twitter. And I will also put a link below in the description where we have all your resources like quarterly letters, etc., which can be viewed also by the public. And that's really great stuff. It's also interesting for myself. So let's come to question number 3. Many investors tend to see in volatile times, like today, the next big crash in the market. Another JP Morgan annual return intra-year decline chart shows the intra-year volatility of the S&P 500. During a year, there can be a lot of painful volatility. But out of 41 years, there have been only 10 years with zero or a negative return at year end. How do you manage volatility? And do you include macro analysis predictions in your risk management?
Yeah, it's a good question. And obviously volatility is one of those things that you feel in the moment. And I think that the data you just presented highlights that it's very moment in time. And then as time goes on, that kind of volatility becomes past, right? And we kind of forget in a sense that it even existed. So it's a function of sentiment. And sentiment isn't a reason why you buy or sell anything. So for us, really, when we think of risk, we think about it at the asset level. Yeah, each company has its own unique risk. So we'll set up key indicators we're following and look to ensure that these are tracking in an appropriate manner. So for us, volatility is a function of that uncertainty. And again, that's not risk. However, we do try to use facts. We try to use data as our certainty and add to those that are being unfairly sold down. So we kind of, the way we think about stuff is we try to ensure that our investors understand that some form of concentration means we will not look like, let's say, the index, and some of the stats you presented may not reflect exactly how we would look. And you're investing in a portfolio of companies that really have been vetted or being tracked, have valuation support longer term, and the investment team is fully aligned and invested in the strategy. So this has historically provided that comfort as opposed to being consumed by these volatile times. So again, when I step back and think about the question around how do you manage volatility, it's really at the asset level that we're trying to manage. And if risk is increasing in a meaningful way, meaning where visibility is totally lost, that's the time we'll exit something, or valuation has been reached. I think those are the two reasons why we would exit something, which means that's the way we would manage risk, as opposed to a security going up and down aggressively. Look, the best stat ever is Amazon's 30% annualized decline going back since inception. Like, this is the best investment you could have made. And you could have 100% go. And I have this chart of Apple and Netflix and Amazon and Microsoft, and it shows like their 3-year rolling volatility from like 20 years ago to today. And it's just this stair step lower as time goes on, that volatility, as the story becomes even more certain, as the bears turned into bulls over time, you start to have less uncertainty, which means volatility starts to be removed slightly out of the name. And look at right now. Look at Apple being basically the safe haven asset, which is quite humorous in my view, from a volatility standpoint. So it's pretty interesting, to say the least.
Yeah, and on the other hand, volatility is also sometimes a great opportunity. And we just discussed Capri Holdings. I remember in the COVID-19 crash, you could buy them roughly for $5-6 at that time at the low, and now we are talking about $60. So that is pure volatility with a great chance.
For sure. I don't want to relive those moments again, but
yes.
but I will tell you, those were some of the more opportunistic moments that any investor could have got across the board. Now, again, you didn't have to dive into that $5-6 range specifically for that name. But in general, like if you looked across the board, everywhere, I mean, it didn't matter. I mean, Square went from 80 to 30 within seconds, it felt like. And the reality is the data was suggesting that Square was improving. And I think like this is the perfect example of where, if you were just tracking some data outside of like the norm, Square was seeing, and Cash App specifically was seeing, outsized user adoption during kind of that March, April timeframe, while the stock was at $30-$40, as if something was materially wrong with it. And I understand why people would think that, but behind the scenes, like the app traffic that was coming to the Cash App was enormous. So that's like fundamentals versus just pure volatility through uncertainty. So that's a pretty good example.
So in our introduction, you told me that you've got a multi-asset strategy and a premier growth strategy. And let's just focus on the premier growth strategy. I guess roughly 6 to 7 positions account for more than 80% of your portfolio. Can you give us some light on your top holdings? I guess you mentioned already some. And how do you manage such a concentrated portfolio in these times?
Yeah, look, it's rather nice to have a concentrated list of companies, because again, you can know these companies fairly intimate, and that's what it's all about, right? It's like the market is a mechanism to invest in companies, and the same way I would try to manage a hypothetical real estate portfolio in your own neighborhood. You would want to buy specific assets. You don't want to buy the whole entire neighborhood. And you would want to own the corner lots on each side, and potentially the one that has less traffic or more traffic, whatever it is, whatever the thesis there is. So for us, there's specific companies like the Capri we've already talked about, but we think that's as attractive as it's ever been, specifically with some of the deleverage plus the gross or the margin expansion that's taking place there, plus the ability to acquire new assets here over probably the next 12 to 18 months. So we think from a competitive standpoint, they're in a really strong spot. So that's and then valuation support from there. Nutanix, again, if you follow either whether it's 13Fs and or just simply Twitter, you'll in our quarterly letters you'll get a sense of what we own and kind of why. And Nutanix is a software company that was a transition story. And again, there's valuation support there. So across our portfolio, I think what you see, I think maybe the biggest takeaway is there's a lot of valuation support across many of these names. So we're not in those, while we invest in structural growth stories, we're not in there to try to tackle the 60, 80, 100x sales multiples and hope they grow into infinity and kind of pay whatever just because it's a great company. Because again, there's plenty of great companies out there. But again, going back to that value discipline that we have innate in ourselves, I think is key. On the other side, it's that transition story mentality where we're trying to find these companies that are going through some form of transition. So the issue there in a market where money is flooding to like a security like Apple because of their massive cash balance, they pay more than the 10-year treasury in terms of dividend and a cash balance that's massive and share repurchases in an environment where people kind of just want the safest things out there. A transition story isn't necessarily as rosy of top of your list in terms of where you want to just start to put money. So again, people are in the names that are structural winners and will pay almost anything for them at this stage. And we're seeing some of that deflate here recently, which I think is super constructive. One, two, I think it provides finally in some places opportunities that we can start potentially investing in. And you saw one of the names recently that we made a small position in and we continue to add, which is Fiverr, which has a pretty nice valuation multiple on it. But again, we took a tiny position. We think this is a structural winner, runs a marketplace for freelance work across the globe. It's kind of in a league of its own. So we like this unique asset. And again, as that valuation comes down, both through growth and through price, we think the cost basis will eventually be incredibly attractive. That will give us that margin of safety longer term. So again, that's kind of like the core of how we're thinking about the portfolio transition, structural growth stories, not paying anything for anything, and ensuring that we have this margin of safety on both sides of the equation. So we're really constructive on our portfolio today. We think, again, many times over in terms of when we aggregate all of our price targets versus our weights, we think many multiples above today. And the highlight of that is we believe that if that takes 5 years, that's 30+% annualized returns. And it may take 5 years, right? And you're flat. Let's say you're flat for 4 years. And if I had the proposition of, hey, in year 5, we go up whatever, and annualized over that rolling 5-year period, you did 30, like what does that mean? Obviously, you're hoping that over time, each security starts to re-rate individually and you don't have to have this large swath that just moves up all at once. But anyways, we're probably more constructive than we've ever been on our portfolio, given the dislocations around all of our names. And eventually, again, we think just like Capri and some others will continue to re-rate and grow over the next several years to hopefully longer for us.
Just for my interest, do you sometimes talk to the management of your holdings? Do you have the possibility?
Yeah, for sure. I mean, depending on which company and what we need to know, I think that's ultimately what we're trying to do. I think what more we do is try to reach out to ex-employees or users of the product, things like that. I think, again, it all depends on what the product is. But for us, we're really trying to use non-scripted kind of highly regulated conversations, as in some cases you don't get that much from them. So just depending on what it is, some are a little bit more open in terms of conversation and some are less open to conversation. But again, any investment we make, we try to build out a list of questions. Why don't we own it, or we own it, but here are the things that we need to look at. And whatever those are, that's how we construct like who we want to talk to. Where do we want to look? What data set do we want to potentially go out and track? Those are all like each story has its own unique thing. So that's ultimately what it is. So
that's so true. There's not the only magic formula or KPI you can use.
Right.
So let's come to question number 5. Last but not least, our last question. On your webpage, Avory XYZ, you share your long-term vision of Avory, which I highly recommend to visit. Can you tell us more about this?
Yeah. So I think our mission, so we have a research mission, right? Discovering value in a world of innovative growth. And it's a buzzy word, it's a buzzy sentence, but at the core of what we're trying to display there is discovery, just continuing to discover, trying to find unique investments. Value and growth in the same sentence, I think, is pretty unique. I think having that valuation discipline, which I hope came across here when I talk about, we're looking for these structural winners. We're looking for these growth winners. However, we're thinking about it, I think, from two sides of the coin: structural growth, which is where the world is headed, and then those companies that are kind of creating that world. And then the other ones that are possibly in the old world that are looking to transition to create themselves or be better prepared for the new world. And all of that wrapped in the kind of this valuation discipline, which allows you to potentially invest in the Wixes and Squares and some of those that are creating the future, but also look at someone like a Capri or Nutanix that are taking such strong core businesses and happy customers and replatforming themselves to be well-positioned for the future. And I think both of those potentially provide opportunities over time. Now, stepping back and looking at the firm, I think our goal is to be the best investment firm kind of on the planet, and doing so in a way that is high conviction, focused on structural growth and transition stories. Like I said before, using data to be informed, and then building a culture that is driven by hungry individuals that like to discover, analyze, but also respect the world around us and are good humans, friends, partners, family members, and professionals. And if that's not a better time to say, if you want to join us, shoot us an email at anyone at Sean@avoryco.com. But that's really it. I think that's the best way to express our mission.
Yeah. So I really like your investment framework. It's very close to how I think and how I would invest. And I guess that many old-fashioned fund managers sometimes try to copy stuff you are doing. So I guess you are on the right side right now. Just one bonus question, Sean. Who is the most trustworthy known investor for you, and what have you learned from him?
I think you have to go with Buffett. Well, I know, again, some of the luster has fallen out over the years, partially because of size and also industry, right? Again, there's this fascination of what's going on in kind of the new economy and slowly looking at that and kind of turning your eye to some of the other stuff. But I do think the core principles of margin of safety, and honestly, just the simple the simple discussion around being rational, I think, and how you invest and how you think. Some of that is built and innate over time, or built and then becomes kind of instinctive over time. But being rational and understanding where there's a potential issue or opportunity, I think is super critical to how to invest. And I think the key takeaway forever for Buffett will always be margin of safety and staying rational in environments where there's either exuberance or fear. And so there's always those core principles that stick. And he's the best. So
yeah, Buffett and Charlie. So Sean, thank you very much for this great conversation. We have learned a lot of you, your company, and in particular on investing. I guess this is a high value for our community, for our audience. Thank you very much for this conversation.